Whenever RBI changes the repo rate, the bond market reacts immediately. But what's repo rate and why does it affect your returns? Repurchase agreement or repurchasing option, repo, is the interest rate at which RBI lends money to banks. Think of it as the cost of borrowing for banks. Now, if RBI raises the repo, loans become expensive. If it cuts the repo, loans become cheaper. When the repo rate goes up, new bonds pay higher interest. That makes your old bonds less attractive, so their market price falls. When the repo rate goes down, new bonds pay lower interest. Your old bonds suddenly look better and their market price rises. So remember, if the repo rate goes up, bond prices go down, and if the repo rate goes down, bond prices go up. If you hold till maturity, no worries, but if you trade bonds, repo rate can make or break your returns. For more simple investing explainers, subscribe to Fixed Returns Academy and never miss a video.
Investments in debt securities, municipal debt securities, securitized debt instruments, mutual funds are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.